Good morning. God, it's like being back at uni. No one wants to sit in the front row. Right, thank you all for coming. I'm Tom. I'm a senior manager at Vistra, and I chair the FutureGen committee. What we wanted to run through today as part of the FutureGen series is a seminar on fund structures, basically taking fund structures back to basics, looking at the setup of a fund, some of the issues when you're structuring a fund, and the guys speaking for us can talk through kind of some considerations. What we're trying to achieve really with the FutureGen network is to give you guys a bit of an overview of some of the basics of fund launch. So I'm sure there's people in the room that have various different roles in the funds industry. So this is a chance to get a real overview of some of the basic stuff to kind of broaden your knowledge. In terms of the FutureGen network, I've seen a lot of familiar faces, so some of you have probably been to our events before. What we're doing here is creating a network for young professionals, so people in the kind of first 10 years or so of their careers in the real estate space, where we can build a network, but also run some educational events like this. So yeah, it should be hopefully fairly educational. There are questions, so there'll be a microphone going around. I've been told to tell you, if you've got a question, wait until the microphone reaches you. And we'll also be using Slido. So for those of you that have been before, you'll have seen we will use this for polls and questions. So if you don't want to put your hand up and ask, you can log on to Slido and ask a question. So we're going to do a quick poll to get a feel of the audience. So those of you that have got phones, if you go to slido.com now, pop in the code 8074. And what we'd like to know is, have you been involved in the structuring of a fund? So whether that's on the legal side, in terms of drafting documents, if you're with an administrator maybe, have you been helping in the setup of the fund? Or if you're a fund itself, have you been involved in the formation and the product development? So it's a simple yes or no. Okay, interesting, 50-50. And once you're in the app, you can use your phone throughout the event to ask any questions. These will come through to us up here, and you can address the guys in terms of anything you want to ask or where you don't want to pop your hand up. In terms of speakers, Alex here has kindly hosted us, and Kerry Olsen are our kind sponsors. They sponsored the series. So this is one of 3 events. We'll be running through various parts of the fund life cycle. We've also got an event in May, which will be looking at some topical stuff on wellness buildings. So that's joint with one of the other AREF committees as well. So keep your eyes peeled for an event. Darren, Patrick and Andrew are going to lead us through. And yeah, other than that, I think it's a quick hand over to Alex to introduce Cass and enjoy the event.
Thanks so much, and welcome to what is basically the grown-up part of Cass Business School. Some of you may have been to the other site at Bunhill Row, which is where all the postgraduates are. This is where we have the executive education and the MBA courses, hence the slightly better coffee and the smarter chairs. We're delighted to host this. In fact, we're delighted to be associated with AREF because it fits very well within our framework of what we're trying to do with the new Cass Research Centre, which I set up at the end of last year. We've got a whole series of events coming through this year, and the main purpose is to engage with industry between the academic side and practitioners. I'm sort of half and half, 52-48, practitioner and academic, and what we're trying to do is a number of things. Firstly, some research reports. We did a piece recently for the IPF on the size and structure of the UK market. We've got an update of that coming shortly. We're also going to be doing one on ESG benchmarking. And also in terms of hosting events. So we host events such as this. We'll also be hosting an event at the end of March on Build to Rent, which will be over at the main site. And if you'd like to find out about all of these, please sign up to our mailing list on the website. And I gather that's also going to be on the AREF website for the marketing, so you can sign up to it there. But make sure you sign up to that to get details of all the events. And we'll also be doing various executive education courses. And our funding comes from industry sponsors. So we have a certain kitty. So we'd like to thank Real Foundations and Real Capital Analytics. And we're going to be expanding the sponsorship list fairly shortly during the course of the year. So thank you for coming. That's what we do here, and that's why we're delighted to be involved. Now, this fits very neatly into what we do from the academic side, but also from the practitioner side. It's going to be starting off by looking at what's meant by a fund, and then in particular the key factors when setting up new vehicles, etc. And then the marketing, so we go through the full range with clearly some topical issues in terms of passporting and future developments in terms of Brexit. So I hope you enjoy the session, and I hope you enjoy your time here at CAS. And I'd now like to hand over to Andrew for the meat.
Good, thank you. Thanks, Alex. Welcome, everybody. He mentioned this is the grown-up part of the school. Well, as a grown-up, come into lecture theatres, I still get panicked. But it's good to see a lot of young faces here, which is the idea behind this. We're going to start with what? No, I didn't go to the briefing.
Ah, right. So forward.
There we go. Forward, left, and right. Perfect. We're going to start with what is a fund. Now, I'm going to ask for forgiveness on behalf of all of us that this is an introduction to it. So what we say here today is not necessarily the be-all and end-all of all of the topics that we cover. We're just trying to give you a flavour of what they're meant, what people mean by certain things they say in the context of sort of fund and fund structuring. So from Slido, the 50-50, hopefully most of you have at least seen or interacted with a fund in some way. We appreciate that most of you are coming from sort of fairly big institutions, and you may only be seeing a tiny part of it. But what you will have seen will only be one of the layers of what a fund is. And the word fund, as simple as it is, covers a wide range of entities, strategies, views, all kinds of things involved. So we're looking at them as layers. But if you peel the layers back and bring it down to its absolute basics, the concept of a fund comes or makes use of two pretty simple economic principles. I can see Alex sort of going, "Ooh, lawyer and economics, what could go wrong?" And the two principles are really the value that can be derived from buying power. The idea that if I take my £100 and try to buy something, I've got a limited range of things I can look at buying. I'll get a limited value for my money and I'll get a limited return. If you then start adding money to my pool and making it a much bigger pool, that buying power increases exponentially. The value hopefully increases as well, and the returns therefore increase. So that's the first kind of economic theory that underpins a fund. And the second one is effectively as simply as economies of scale. The more people who share in the cost of a structure, the bigger, better structure you can build. Simple as that. So you put those two things together and you end up with taking away entities, domiciles, all this sort of thing. You end up with an arrangement with these kind of four key ideas or principles. One is that third-party money is sourced. So you go out to all and sundry and ask if they want to put money in to a venture, or they're looking to put money into a venture. You take that money with the objective of investing in some sort of asset, whether it's real estate, equities, pizza chains, whatever else. You utilize a manager to manage those assets for you, and he brings with him his particular strategy. That's really what underpins the fund. It starts usually with somebody, an investment manager with a bright idea. He has decided, if I buy X at a certain time, do this with it, I can sell it for Y and make a return for you. It's as simple as that. And then with the aim of generating a return on that pooled money to the people who put their funds at risk with the manager. That return can be some sort of income stream. In the context of property, it's rental income that goes back to the investors as distributions, or it can be some sort of capital appreciation on the asset, that you buy it for X, you sell it for Y, you make a return, or any combination of the two. So it's as simple as that. Does that mean if I have seen one, I've seen them all? I know you can leave now after 5 minutes, you know what a fund is. Well, no, because of course it's never as simple as this is a fund and away we go. As the finance industry has evolved, so have the entities, the concepts, the ideas, and essentially all a fund is a product. And as you know, any one product can be morphed, varied, or changed to a number of different ways. So the use of the word fund is actually very wide, a very wide one, and goes away from the traditional core that I just spoke about. And if we look at fund, umbrella sub-funds, co-investments, and master feeders, those for me are simply add-ons to the definition that we just saw. So an umbrella or sub-fund is effectively taking that previous concept. You would normally have a pool of money, you invest in a range of assets. Well, an umbrella sub-fund is effectively, you've got a pool of money, you take part of it and you invest in a particular strategy, another part goes into another strategy, and a third part goes into a third strategy. That's as simple as an umbrella sub-fund. Master feeders, again, it's still the core fund of pooling money, but there are reasons that you would have one vehicle on top, which is where you collect all the monies from investors, that then simply puts it all into a second vehicle, that then invests in all the assets. That's a master feeder structure, usually tax-driven. Tax is usually the driver for the master feeder structure. And co-investments and parallels, again, you have your normal fund construct as per the previous arrangement. For one reason or another, a certain number of investors can't use that. You create a second one, and they invest in parallel. So all those are simply add-ons to the main idea of a fund. When you move to clubs, JVs, or fund of one, segregated mandates, for me, those are variations on the theme. So they are, to my mind, missing certain of the elements of the previous slide. If we look at, for example, a fund of one or segregated mandate, they sort of cross over a little bit. A fund of one tends to be, or let's go with segregated mandate. Segregated mandate tends to be a particular investor who has a massive slug of investable capital that they want to use. It's big enough they don't need to be pooled with anybody else, but they want that manager to do it for them. They make arrangements with that manager to manage that pool of assets for them. So we've effectively gone away from the third-party money and pooling because actually the buying power is already there. They're investing, the likes of CalPERS in the US as a massive pension fund. They will have huge amounts of money to put into investment. They don't actually need always to club together with anybody else, but they do need the management experience. So they go out and they utilize that on a segregated mandate basis. JVs and clubs, again, joint ventures tend to be in relation to single assets. So you'll get a range of people or a range of investors who decided to come together to buy X or to do Y deal. So again, we move away from the spreading of risk and the buying of a number of assets, and it's focused on one. But again, the same general principles of fund, hence the use of the word to describe those on occasion as well. What is an AIF under ARFMD? Well, thankfully, I'm not having to go into this. Darren is going to go into that a bit more when he does his section in relation to a bit of regulatory and marketing. But I'm sure all of you will have come across AIFMD. Even if it's just flashed up on the screen, it's the Alternative Investment Fund Managers Directive. It's an EU piece of legislation that was designed to harmonize the creation, running, and regulation of funds throughout Europe. That's what it's for. An AIF is simply an alternative investment fund. It's what they describe as a fund under AIFMD. And those are the pieces that are required to constitute an AIF under AIFMD. So all this slide is to show is that you take the original core arrangement that we're talking about. These are some of the additional features that you need or don't need in order to be caught by EU regulation. Patrick and Darren will both cover a bit more on the sort of regulatory side. So, planning. You've got a manager with a great idea. What's next? Some of you may be sat in structuring, some may be sat in asset and dealing with transactions, some of you may be sat in investor relations within the various businesses that you work. A lot of those pieces go together. And at its heart, a fund is simply a product. And you need to build that product and design that product in such a way that people are going to want it. It's effectively the Dragon's Den approach. You need to be able to stand in front of people and explain why they need to be part of this. They must take part. You're going to lose if you don't. So we're going to go quickly to a Slido question. I just want to get some thoughts, people's thoughts on what do you need to think about when you're planning or structuring a fund? What comes to mind? Put yourself in the position of, I don't know, the investor, a potential investor. What are you going to want to know? Put yourself in the position of the manager. Okay, should have brought my glasses. There we go. Okay. Yep. Returns, investors, yeah. Fee basis, strategy, tax implications. So investment restrictions there. Returns going to offer fund life. Yeah, absolutely. Excellent. Do we switch off of this? Cool. That's exactly where we were going with this. I might just add, I'm pleased to see that nobody put there what color Ferrari I'm going to buy when I raise all the money. You know, I do say that glibly, but one of the things that we will cover here has to do with the authenticity of managers, etc. And there is no place in our world, the fund industry, for part-timers and people who play loose and fast. So as much as I joke about that, there is a serious undertone to that comment. So we go back to our Dragon's Den. Here are some of the key things that we've picked out that are relevant to structuring a fund. Again, I'm going to pick on certain of them given time constraints. What the manager's USP, who the target investors, is the structure familiar, and structuring. For me, those are all the fundamentals, and they are the external fundamentals, the client-facing fundamentals, the investor-facing fundamentals. Those are the things that you need to be able to say to investors. From my perspective, the other bits are then directed or driven by the answers to those 4 particular questions. As I mentioned before, the idea of a fund is simply, it starts with somebody's brilliant idea of a strategy and the next big thing to invest in. And that is the manager's USP. Lots of great ideas out there. Are they going to sell? What is it about your strategy that is going to interest investors? Is it saleable? Do they want it? Is it something people want? Is it going to make a return for them? So you've got to ensure that there is a strong USP, particularly market-wide, where there's so many managers, everybody's trying to access money of all levels. You've got to be out there with a strong idea on how you're going to generate the returns from the use of the money. That's very much then going to drive who your target investors are. If you've come out of a private equity background and you're now in a real estate fund, your little black book may not be the same investors that you're going to need to target. And there is no point wasting everybody's time and effort going in to see investors who just are not interested in the particular asset class or strategy that you're looking at. So targeting your investors is key. Is the structure acceptable and familiar? Patrick is going to cover a lot about entities and domiciles and all these sorts of things. Again, you're going to be having enough difficulty trying to sell your idea and strategy. What you don't also then want to be doing is also trying to have to justify the packaging of what it looks like. So again, you're going out into the market, you need to make sure that you know what they're willing to accept. Yeah, there's no point. I was looking at something on Good Morning Britain or otherwise where they were doing some sort of candy cake stuff, but designing it to look like a pizza. Now, I'm sorry, pizza is pizza, candy is candy, the two don't mix. So you need to be sure that you're talking to the right people about the right package for the product. And then finally, structuring. That's going to be key. How are you going to take their money in, spend it on assets, generate the returns in as efficient a way as possible, and return those monies in as efficient a way as possible? Those 4 things all drive massively everything else. You all in the Slido picked up a lot of things like setup costs. You did pick up regulation, tax, all those things are extremely important. But for me, those come after you formulate the idea and what you're going to do. And then just finally, some additional considerations that are worth separating out. Again, the slide, somebody picked up on the Slido question. What are the investors looking to achieve? That ties in with your investor base, but goes, or the target investor base, but goes beyond that. Investors are driven by risk appetite. They're driven by spreading their asset base. So you need to know what they're looking to achieve. Are they looking for income capital returns? Do they want a specific asset exposure, real estate, infrastructure, emerging markets, whatever it is? And the sort of last main point that I'll sort of talk about is the sponsor track record reputation. Now, I'm seeing a lot of young faces, no gray hair in here at all. So you as a group are very unlikely to have been burnt by the financial crisis. You will not have been there when it all went so wrong. A lot of investors were, and a lot of the people that you will be talking to try to get invested in your fund or your business have been there, and they want to know what's going to protect me if that happens again. And track record and reputation have been one of the key fundamentals. Reputation is something that's built over many, many years and lost in seconds. So the thing I would leave you with on that is whatever you do, do it with integrity, do it with full information, because risk is something that is accessible. Risk isn't a bad thing, so long as you know what it is. But that's a very important point on structuring a fund, is track record and understanding of it. And then, of course, fees are always a big interest to investors. So that's it. That's my whistle-stop tour of what a fund looks like. I'm going to hand over to Patrick to pick up on some other points.
Thank you very much, Andrew. So I guess Andrew's given you a more high-level overview of some of the planning initial considerations. I'm going to delve into a little bit more detail on the jurisdictions and the types of fund vehicles that you will encounter when structuring a fund. So, and I'll also go into a little bit about regulation and legal forms of vehicles, although Darren's going to touch more on regulation later. So, firstly on jurisdictions, and Andrew's already kind of talked about this, I suppose, in a planning context, but we're really talking here about where is your manager based? Where does it have operational capabilities and substance? Where does it have the relevant regulatory permissions to carry on the business that it wants to do? What's your fund strategy? What are your target assets? Where are they located? Where are your investors? Certain types of investors will have a preference maybe for certain jurisdictions or certain types of fund vehicles. We're working on a fund at the moment where an investor doesn't like the idea of investing. It's a French investor, doesn't want to invest into an English limited partnership, so we're specifically having to set up a Luxembourg domiciled feeder to accommodate that investor. And then a little bit in relation to tax and regulation, which obviously will vary from one jurisdiction to another. So in terms of onshore versus offshore, there's no real defined term of what is onshore, what is offshore, and it very much depends on the perspective from which you're looking at it. But I guess if I was to try and condense it, I would say that the onshore funds jurisdictions are really jurisdictions that might have a domestic serving funds industry, whereas the offshore jurisdictions typically are jurisdictions that may primarily serve international or other jurisdictions funds industries. So looking at some of the jurisdictions up there, UK is a primary example of an onshore jurisdiction. I guess you might say France and Germany are other examples, whereas your classic offshore jurisdictions are places like BVI, Cayman Islands, and Channel Islands. There are then some jurisdictions which are potentially viewed either way and halfway houses, places like Ireland and to an extent Luxembourg. I won't go into a lot of detail about the different jurisdictions, but just touch on a few. So the UK obviously will be familiar to most of you. It has a very diverse and mature funds industry across real estate, private equity, and many other asset classes. Luxembourg is the preeminent centre today for pan-European real estate funds. That's only going to become more so the case with Brexit obviously on the horizon. We're doing a lot of work at the moment on advising managers on shifting the management of their funds over to Luxembourg or even re-domiciling funds to Luxembourg. I suppose Ireland's on that list. We do encounter it sometimes in the real estate sphere, although I'd say it's typically more focused on the regulated and retail funds market. Delaware, it's worth mentioning, isn't on that list, but it has a fairly substantial share of the global funds market. It's really I'd say Delaware is mainly the kind of domestic US funds market, so most US private equity and real estate funds tend to be domiciled in Delaware. And then obviously Channel Islands, which is Andrew's piece, you've got Jersey and Guernsey, and they both have very mature and well-developed funds industries, particularly in the real estate and private equity sphere. So moving on to closed and open-ended funds, and here we're really talking about liquidity. What do we mean by closed-ended? Essentially, a closed-ended fund has typically a fixed life, anything from 7 to 10 years typically, and that life will then be divided up into certain segments. So you have your capital raising period, which is the period during which the manager will essentially go out to the market, look to raise money from its investor pool, and then that could be anything from, say, 1 to 2 years from the inception of the fund. You get to the end of that capital raising period, and then with a closed-ended fund, that's it. There are no more subscriptions, and you're then moving into your investment period, which is the period in which the manager then looks to deploy the money it's raised into acquiring the assets within its target strategy. The length of the investment period will vary depending on the asset classes and the strategy, but you may see typically anything from 3 to 5 years from your first or final closing. Just a little bit actually, just going back onto closings, with a closed-ended fund, you typically will have a number of closings during that capital raising period. And investors will subscribe for an investment amount, and we refer to that as a commitment. And to the extent an investor comes in at a closing that's later than the first closing, that investor typically has to pay an additional amount to effectively compensate the existing investors for the fact that it has come into the fund at a later date, but is participating in the performance of the fund from day one. And so that's effectively rebalancing and equalising the investors between each other, and that's why we refer to that as equalisation. So if you hear that term, that's effectively what that's achieving. Once you get out of the investment period, typically the manager then cannot draw down money from its investors for any new investment activity. And from that time on, it's then looking to manage the assets with a view to realising those assets, returning amounts to investors, hopefully with a profit on top of it. And then as you get towards the end of the fund life, it's selling down all the assets and then looking to wind up the fund. I talked a bit about liquidity, and with a closed-ended fund, we typically say they have limited liquidity. And by that, I mean that a closed-ended fund, you cannot, as an investor, usually withdraw or redeem your investment. You are locked into the fund during the fund's life, and your only real liquidity is usually either to receive back your money as and when investments are sold, or to trade your interest on the secondary market to another investor. But depending on the fund terms, there may be limits on your ability to do that, so you might need the consent of the sponsor house. So contrast that with open-ended funds. An open-ended fund typically has a perpetual life, so either no fixed term at all, or at least a substantially longer term than any closed-ended product. And the main difference is that during that life, the fund is being perpetually marketed and can perpetually raise capital from investors. Likewise, generally speaking, investors can also withdraw their investment during the life of the fund, and contrast that with closed-ended funds where there's limited liquidity. From a real estate perspective, most real estate funds aren't truly liquid or truly open-ended, and that's because real estate, as you know, is an inherently illiquid asset class. It takes time and money to sell a real estate asset, and for that reason, with open-ended real estate funds, you typically see various controls in place to manage liquidity risk and manage the liquidity process. So it may be anything from redemptions only being available at periodic intervals. So it might be quarterly redemptions, biannual, annual. So very much different to your freely traded mutual fund where you might have daily liquidity, where you're dealing with underlying liquid asset classes like marketable securities. You also might see limits on the amount that can be redeemed during any 1 year. So we typically refer to that as a redemption gate. So it might be no more than 10% of the fund's net asset value can actually be redeemed during an annual period. And then you also sometimes see lock-in periods. So an investor, as and when it subscribes, can't actually redeem its interest for a period of, say, 1, 2, 3 years from that date. The key with open-ended funds is pricing. So when I talk about pricing, I mean that an open-ended fund has an underlying net asset value, which is the value of its assets, less liabilities, and essentially the price at which you can buy into the fund or subscribe for an interest, and the price at which you can redeem or withdraw your investment is typically linked to the fund's net asset value. So as and when the value of the underlying assets go up or decrease, the price at which you can buy into the fund or sell out will also fluctuate accordingly. There are various variations on the pricing model. There's the pure net asset value where you buy in and buy out at net asset value. That's less common. You may see variations where, for example, the price at which you buy into the fund represents a slight premium on the net asset value. Likewise, the price at which you can redeem your investment might be a slight discount on the net asset value. And that's typically what we refer to as a bid-offer spread. There are various other variations on the bid-offer spread or the NAV pricing model, but I won't go into too much detail on that today. You've got semi-open-ended up there, and we've already talked about real estate funds not being usually truly liquid, but it's also just worth mentioning that end of fund life, and I think some of you identified that in the planning consideration slide question earlier, but that's been a very topical and hot topic in the funds industry over the last 5 or so years. And really, by talking about end of fund life, we mean where you have for example, a manager who's launched a closed-ended fund. They've invested an enormous amount of time and energy and resources into setting up that fund, going out and raising the money, and implementing that investment strategy. You then get to the end of the, say, 7-10 year term. They've then got to return that money to investors and wind up the fund. And it may be that it's not the correct time in the property cycle to do that. So there's this conundrum for managers with closed-ended products of actually, it's not always ideal to have a fixed term life and have to then go through the whole process of raising another fund. So we've seen a lot of talk in the industry around semi-open-ended or evergreen products, and there's a whole number of variations on that theme, but it might be, for example, you have a fund with liquidity windows at fixed intervals, say every 5 years, every 10 years, there's liquidity offered to investors, or you may have a fixed term fund with an option for the investors to vote to extend the fund at the end of the 10-year period, for example, for another 10 years. So it's ways of effectively managing that end of fund term risk for sponsors. I won't go into too much detail on regulation because Darren's going to talk to that later, but when we talk about regulated and unregulated funds, what we really are talking about is the actual fund vehicle itself. So obviously, almost any fund structure is going to be subject to regulation in some way or form, whether it's the actual fund vehicle itself being regulated or the management of that fund being regulated. Almost all fund management activity or investment advisory activity tends to be regulated in some form or another. But looking very high level at regulated funds, we're talking about the actual fund vehicle being regulated. So whether that is, it would be regulated by its local member states. So in the UK, you have the FCA. There are other competent authorities in Luxembourg. You've got the CSSF, for example. In Jersey and Guernsey, there's the GSFC and the JFSC. I think I've got that right. Yep, a lot of acronyms. But it's subject. The fund itself is subject to regulation, and because of that, there's much more close oversight and control over the fund's activities, and much more prescriptive rules about what the fund can and can't do. And for that reason, regulated funds tend to be geared towards the retail market. And by retail, I mean your every man on the street, as opposed to non-retail investors who are your sophisticated, professional, institutional type investors. There are various different types of regulated fund vehicles. So in the UK, we've got a few there: unit trust, open-end investment companies, PAIFs you may be familiar with. And then, for example, in Luxembourg, you have the CCAR and the CIF regime, which are both regulated fund regimes. So a CCAR or CIF will be subject to supervision by the CSSF. We've already talked a little bit about AIF MD, and that is the EU's regulatory framework for unregulated fund products. And Darren will go into more detail on that later, but just touching on UCITS there, essentially UCITS is the counterpart to that, so it's the European framework for the open-ended regulated retail fund space. Where a fund is regulated as a UCITS in its home member state, it can then be freely traded to retail investors throughout Europe. Now, a UCITS has to offer liquidity. Most, not all, but most, I think, have daily trading, and for that reason, we don't typically come across UCITS too much in the real estate sphere. So we've talked about jurisdiction and regulation, but moving on to the actual legal form of the fund vehicles. To really, really oversimplify it, you have on the one hand corporate structures, which are incorporated entities which have their own separate legal personality. And on the other hand, you have unincorporated entities, and they can take many different forms. We've got the most familiar examples up there: limited partnerships and unit trusts and other contractual arrangements. I'm not going to say too much about corporate vehicles because, generally speaking, in my practice as a private, unregulated real estate funds lawyer, I'd say most of the vehicles we come across in our day-to-day work tend to be unincorporated entities. So the limited partnership I'd like to talk about, and I think at the back of your slides there are a couple of example fund structures, one for a Guernsey fund focused on UK real estate, and then another one for a Lux fund, which is focused on pan-European real estate. And I think you'll see in there a number of these different vehicles are actually incorporated into that structure chart, so you see how they're used in practice. But the limited partnership, there are a number of variations across different regimes, whether it's Channel Islands, UK, or European jurisdictions like Luxembourg, but they all are broadly similar, and essentially they're very flexible vehicles that tend to be subject to relatively limited legislative kind of regulation. So effectively, by and large, you can agree the fund terms with your investors and document that in an LPA without too much external intervention. Generally speaking, limited partnerships are tax transparent. So by that I mean that the underlying capital and income profits that the partnership generates aren't taxed at the level of the limited partnership. They are taxed at the level of the investors in the hands who receive those profits. A limited partnership has limited partners who are the investors, and they have limited liabilities, so their liability towards that fund is limited to the amount that they have contributed towards the fund. And then you have their limited liability, by the way, they only have that limited liability as long as they don't get involved generally in the day-to-day management of the partnership. So the management of the partnership is the responsibility of the general partner, and that general partner is typically an SPV set up by the sponsor house. You then also, typically the GP will then appoint an external or maybe an in-house investment manager or investment advisor who will advise the GP on the fund's investment strategy. Just a word on unit trusts, because I know that's definitely something that will be familiar to Andrew's business. They're used a lot in the Channel Islands and Jersey and Guernsey. A unit trust is essentially a contractual arrangement. It's governed by its trust deed, and essentially a trustee is appointed who constitutes the trust and holds the legal title to the fund, to the trust assets on behalf of the unit holders, who are the investors. Those investors have units in the scheme, and that gives them effectively a beneficial or an economic interest in the assets. In the same way as a limited partnership, a unit trust can also appoint a manager or an investment advisor to implement the investment strategy. Very briefly on listed vehicles, and this is kind of straying outside my own personal expertise, but I just want to mention a bit about REITs. So REITs from a UK perspective were introduced, I think, around 2006 or so. 2007, okay. There you go. And originally they were actually introduced, and the take-up was predominantly not in the funds industry per se, but it was more property companies. So a REIT is essentially a closed-ended, publicly traded company, and it offers effectively tax exemptions or tax efficiencies on its underlying property investment business. So the classic examples that you may be familiar of REITs out there are big property companies, listed property companies like British Land, Hammerson, Segro, Land Securities, I think are the classic ones. And so initially those were the kind of vehicles that took up REIT status, and they are not funds, they are kind of trading businesses. But I think around 2012 or so, they introduced the concept of a private REIT, which effectively is a REIT that's not required to be publicly traded, so it can be closely held by a limited pool of institutional investors. And the introduction of the private REIT has seen increased take-up of REITs used within fund structures as holding vehicles because the tax efficiencies that they provide. You have to comply with various regulations to enjoy those tax exemptions. But we are increasingly seeing them used within holding structures, not actually as fund vehicles themselves, but as asset holding vehicles. Just finally, on jurisdictions for listing, you have your onshore jurisdictions. So for UK, for example, you're talking about the main market and AIM. And then you have your offshore exchanges like the International Stock Exchange in the Channel Islands. And where we look at private REITs and using REITs within fund structures, it's generally probably true to say that a main market listing wouldn't be appropriate because of the cost, the time, and the ongoing compliance and oversight that you need for a main market listing. And that's why the TISC has been particularly popular for private REITs, because it provides a much more cost-effective and attractive alternative to a main market onshore listing. So with that, I'm going to hand over to Darren to talk a bit more about regulation and marketing.
Thanks, mate. So we've heard a lot about acronyms and AFMD. So what I thought I might just say, is there anyone here who has never actually heard of the AIFMD? That's a pretty good start, I suppose. All these things we're talking about, corporates, listed, offshore, onshore, all this stuff, what it's about is, when I'm setting up my fund, we've heard about all the planning. It's like, what am I now going to do? Where am I going to set it up? What am I going to do? Am I looking at regulation? Am I not looking at regulation? The reality is that before the onset of AFMD, which came in about 6 or 7 years ago and was talked about before that, I don't think managers thought much about regulation when they actually were doing a fund. It was probably one of the last things they thought about. A manager itself maybe was regulated to do certain things, but they didn't really think about it that much. I think it wasn't one of the four things one of the things at the forefront of their mind. Whereas I think nowadays, it actually is quite an important factor, and particularly with Brexit. So basically, AFMD doesn't regulate funds. So you've heard about, when you're thinking about setting up your fund, do I go for a regulated product, which is one where there's going to be a lot of rules, there's going to be a lot of oversight by supervisory authorities, so that means there's going to be a lot of cost. So you say, am I going to get a regulated fund or not? The other side of that is you have an unregulated product. But with the introduction of AFMD, which really came about because of the global financial crisis, the Madoff scandal, if people remember that, which was basically a dude who took lots of money and basically spent it on himself, 4 jets and Ferraris, and was basically a pyramid scheme. The EU decided we're going to bring in a regulation across Europe, which didn't really exist for the type of unregulated products that we work on now, that basically was supposed to protect the investors. But interestingly, AFMD doesn't regulate your fund, it regulates your fund manager. So that's the first thing to point out. And the idea is that if I get regulated in one jurisdiction within the EU as a manager, I can then basically provide that service across Europe. So it was meant to harmonise the European industry, really, in relation to the regulation of fund managers. 2 things to note. What it does is it basically creates something for the manager to do what we call portfolio management, which is really making decisions. What am I going to buy? What am I going to sell? And you're doing that on behalf of your third-party investors who are basically passive investors. So there's portfolio management and then there's risk management. Risk management is really diversification. What are the debt limits? Protecting the investors from basically unwanted risk. So you see, I can invest 10% in this country. I can invest 20% in that type of product. So it's really looking at those two main aspects as portfolio management and risk management. There's a whole bunch of other stuff that you guys will do, so investment advice, marketing. That is not the primary function of what a fund manager does under AFMD, though it is something they can do as ancillary services. As I said, the Fund Management Directive doesn't regulate the fund products themselves, but what it does indirectly is require the manager to do a lot of stuff that does bring about protection for investors. So there are transparency requirements, there are disclosure requirements. It basically sets out a list of stuff that you need to do. The reality is, I don't think that what fund managers did before AFMD is really that different to what fund managers do now. It's just now you have a much bigger formal checklist that you need to go through and make sure, have I done this, have I done that? Am I doing everything the regulation requires me to do? What it also brought about was the introduction of the depository. So these concepts were often quite common, say, in Luxembourg originally, where they had a more regulated style of products. And you've heard about sort of CIFs, which is a more lightly regulated product, but has a set of rules you need to follow, and CCARs, and UCITS, which is very heavily regulated. So what it did was it brought about, we have to comply with these particular requirements to make sure that they're within our products. But I don't think managers really do that much differently. But they did bring about this concept of a depository, which is in effect someone who is a third party, usually a bank or a similar organization, who has to really have oversight of the ownership of assets within the fund. That has added a layer of cost. So I think what AFMD did do, practices probably didn't change that much, but what it did do was basically add an additional layer of cost to what managers basically had to do. Notwithstanding AFMD is a pan-European regulation, in every jurisdiction they have their own regulation as well. So you now are considering double layers of regulation quite often in relation to the product. So I have to comply with my local regulation and basically the European regulation. With the onset of Brexit, which I'll touch on a bit in a sec, that's actually becoming much more important now because the UK will no longer be part of the EU, subject to what the agreement is that is reached. And on that basis, we're going to have to think a lot more about local regulation and international regulation at the same time. So again, what that's doing is putting on a layer of cost. So for example, in the UK, there may be certain things that you do. You may be advise on investments. You may be arrange deals between people. You may be manage investments. Those things generally are regulated if they relate to a product that is regulated. So for example, shares, securities, interests in funds. So if I advise you on buying this particular company, that is regulated. What I put up here is direct real estate. Now the interesting thing is generally across Europe, real estate of itself is not regulated. What that means is if I'm just telling you or advising you or managing your money to buy property itself, buy a building, that is generally not covered by regulation. However, if that property is owned by a company or it sits in a fund, and I'm advising you or recommending or I'm managing your money to buy that company or that fund, that is regulated. So you need to think about what am I doing in my jurisdiction? Is that regulated? At the same time as what you're doing across Europe on a European-wide basis. Prior to AFMD, marketing of itself was not really a regulated activity. Going to sell a product didn't really have a sort of position within a regulatory framework. People were usually doing something else that was regulated. As I said, you might have been advising someone on investments. You might have been arranging deals. And that idea of selling a product was usually pulled in with that other regulatory activity. One of the things that AFMD was supposed to do was basically harmonise marketing across Europe. It meant to be, I can get regulated, as I said, in one jurisdiction to manage a fund in another jurisdiction, so I can get regulated in the UK to manage a fund in Luxembourg, or I can get basically permission to market my product across Europe. So I only have to go to one regulator for one permission. That regulator will then liaise with the rest of Europe, and that basically means that I can then market cross-border. Now, the reality is what happened is nobody agreed on what marketing was. So you sit there and you say, okay, that seems quite simple. So you guys tell me, what do you think marketing is? Give me an example of something you think might be marketing. Any ideas?
Sending a documentation to a manager, to an investor.
Sending documents to a manager, is that marketing? Or sending it to an investor, I suppose. Sending your documents to an investor, is that marketing? Having a term sheet, having a phone call, sitting here at this seminar and telling you about my wonderful product that I've just basically decided to launch. The simple answer is across Europe, they didn't agree. And everybody thought something different about what marketing was. And what historically happened was what a manager would do is, I don't want to spend lots of money going out marketing a product that nobody wants to buy. So what they did was what we call soft marketing. So that is having soft chats, maybe drafting up a small idea, having a teaser presentation, a little template, sitting around with a bunch of guys that I knew quite well and saying, do you want to buy into my product? Now, the problem is each jurisdiction would say, some would say that was marketing, and some would say it wasn't marketing. So you had to be very, very careful in relation to what you could do. So historically, there was no sort of European-wide idea of marketing. AFMD was supposed to bring that in, so everyone had a level playing field, but that didn't really happen because everyone thought quite differently about what marketing was. There is a consultation at the moment where basically the EU is trying to harmonise that idea of what marketing is and make soft marketing more available generally across the market. One thing I've got here is reverse solicitation. That basically means I don't sell to you, you come to me and you ask me about my product. That is not marketing, that is not covered. But of course, if I raise a fund and I say I raised my fund on reverse solicitation, which means everybody came to me, that's not very plausible. How did anybody find out about that product? Maybe if you get one or two guys who have heard about it from their mates and come to you, that's okay. But it'd be very difficult to rely on the idea of reverse solicitation to raise your fund. The other thing I've said here is professional investors. So professional investors is actually quite a high threshold under AFMD comparatively. So in the UK, we have a much more relaxed marketing environment, I would say. So basically, if you are basically a rich guy, I can basically market to you and you can give me your money. In a nutshell. Under AFMD, you can't just be a rich guy. You actually have to be someone who is involved generally in the market, if you're in banking, if you're in regulation, and you do this kind of on a more regular basis. So basically, it's a true professional investor, and a lot of what we do is it. So it's big institutions, pension funds, etc. will be fine, although pension funds are slightly a bit odd, actually. But generally, it's not the man on the street, it's not just some rich guy. You have to be someone who does this for kind of a living. So we talked about the way you can market within the EU. So what the AFMD does is it really gives lots of benefits to EU managers with EU funds doing stuff in the EU. If you don't fit with any of that stuff, you potentially can be captured by a little bit of regulation, but you don't get the benefits of AFMD. So if I'm marketing an offshore fund potentially, if I'm an offshore manager, I can't use this passport. I have to use what's called national private placement regimes. And national private placement regimes really are what people used to do in the past. So if I'm a Channel Islands fund, I don't get the benefit of AFMD. I need to use national private placement regimes generally. Very soon, if the UK is not within the EU, we'll be in exactly the same position. And that national private placement regime is a bit like what we talked about with that soft marketing, pre-marketing. It's all quite similar. Can I have a conversation? Can I send you an email? Can I send you a short presentation? Can I actually send you draft documents? All those things are treated differently in every jurisdiction. So it becomes much more expensive when you're doing that process to determine what it is you can and can't do. That's really just to give you a little bit of an idea of, can I do this private placement in particular jurisdictions within the EU that is not within the AFMD? So this is basically, you can see some countries it's quite easy, Netherlands, the UK. Some countries is very hard, like France, Spain, for example. France itself doesn't allow private placement. So unless you do that reverse solicitation, so an investor comes to you, it's going to be very difficult to market into France under these rules. Right. Brexit. From my perspective, Brexit has had was basically one big advantage for Luxembourg. Because we have managers now that sit here and say, I don't know on the 29th of March what will happen to me, what will happen to my fund, whether I can utilize the European benefits of passporting, both in managing and marketing, we see a lot of managers now saying, actually, I'm going to set my fund up or my management up in Luxembourg. And we've seen that more than anything, more than Ireland or other jurisdictions, more than, Luxembourg clearly is a winner. Because what people are concerned about is, come the 29th of March, they no longer can access the European market. And that is generally a huge market. Now, if you're raising an Asian fund from Asian investors, you don't really care about AFMD. You want to maybe set your fund outside of AFMD, so whether that's in the Channel Islands or Cayman. But if you want European investors and you have European products, it's becoming quite tricky. So we see a lot of managers, for example, what they're doing at the moment, they may move their own management to Luxembourg, or what they might do is they might engage a third party, like someone like Citco or Alta Domus or Crestbridge, these sort of names that you've heard already, Vistra, these types of guys, and say, I'm going to operate in the UK, but what I want you to do is, in Luxembourg, be my manager. And they will pay them to provide the services under AFMD and allow them to then access the European market. That may be temporary while they try to get themselves set up, or it may not be. And if you might remember, what I said was under AFMD, you're allowed to do two things: portfolio management, do I buy and sell, and risk management. You don't have to do it all. What AFMD says is, to be a manager, you can't be a letterbox, which means you can't give away everything, you can't delegate everything. But what a lot of managers are now doing is setting something up in Luxembourg, either by themselves or with a third party, and then keeping the risk management function, which, let's face it, is a little bit more monitoring, a little bit less exciting, in Luxembourg, and delegating back to the UK, to their UK managers, the portfolio management. So buying the assets, finding the assets, dealing the assets. That seems to be the model that we're seeing happening quite a lot. And that is permissible at the moment. And so in that respect, basically, like I said, we're seeing Luxembourg as quite a big winner. Equally, managers managers are setting their funds up in Luxembourg, because if you have a non-EU fund, you can't then also get the benefit of the passports. And if UK is not within the EU, then basically that's going to be a disadvantage as well. I don't know if you want to talk a bit about it from the Channel Islands perspective.
Yeah, I can do. Just very quickly on that, I suppose we're obviously then seeing the opposite effect, which is, as Darren mentioned, if you have no connection to the EU, your investors are not in the EU, you're not an EU manager, but you are wanting to buy property in the various countries, you can set yourself up entirely outside of the AFMD regime. And what AFMD has actually done is created quite a polarizing scenario, and it's actually in a lot of ways works anti-Europe, because it's actually preventing people from accessing European investors. I think one of the statistics in relation to the use of AFMD and the passport was, of the passport, they only ever utilized 3 or 4 of the countries out of 27. So query the actual value of the passport. So just in terms of what we're seeing in the Channel Islands, we've got, for example, an Irish fund that's set up at the moment, where all their investors are South African, American, non-EU, and they're effectively re-domiciling because they're a UK manager. So they want to be completely outside of AFMD come Brexit if it happens. So that's just a...
Okay, so I think that's really all I wanted to touch on there. So as we said, today has really been a whistle-stop tour. It really is an intro to funds. The follow-on sessions will look a little bit more actual structures, at tax. I think we're looking at the ideas that go behind the business development, the marketing. It's really trying to give you a flavour of what people think about and what people are looking to achieve when they're raising their funds. I don't know if people have questions or if we had any questions.
Yeah, there are a couple of questions.
All right.
One of the first ones was, what fees does a manager usually charge?
Okay.
Or how many Ferraris can they buy?
Sorry, I'll just say at the back, you've got a couple of fund examples like Patrick said. So that's like a relatively typical kind of UK pan-European real estate. Oh, sorry. Yeah, that is actually... No, that's the UK real estate fund, sorry. So this has got a Channel Islands sort of entity. This one is actually more of a pan-European, but in some ways you can see they don't look that different. It really is just what is the product and where is it set up. In relation to fees, I suppose the answer is it depends on the type of fund you're raising. If you're raising a closed-ended product that is, usually managers will charge, say, 1.5% of the commitments of investors, then it will change it. So as Patrick said, you have what we call an investment period. During that period, they would typically say 1.5% of the amount that you have committed to the fund. After that period, it usually drops down to 1.5% of the amount that you've actually given them. So it's how much have I agreed to give you, and then how much did I actually give you? And that will obviously reduce. Now, also, it's very common that big investors, repeat investors, relationship investors all get discounts on those fees. That's pretty common. In what we would call, say, a more open product, the fees are done slightly differently. They don't tend to be done on how much have I given you, that may be a starting point. They're often done on what is the NAV, or the net asset value, or the gross asset value of the fund. And I would say generally those fees are around, say, 0.5% of gross asset value, or 1% of the net asset value. But again, nowadays what tends to happen is the bigger you are, the more money you give a manager, you get a discount on your fees. And a lot of these things are often set out in the fund document. So it will be, 0 to 25 million, you pay the full fee, 25 to 50, you get a small discount, 50 to 100, a bigger discount, and above 100, let's have a negotiation.
There were a couple of questions on capital gains tax, the changes to the legislation in the UK. It's a whole seminar on itself, but can you make a quick comment on how that's going to affect people using offshore structures?
So as Tom said, AREF is hosting and has hosted already a capital gains tax seminar, and we'll be hosting another one in a couple of months. Basically, historically, one of the big benefits of the UK was that offshore investors did not pay capital gains tax on the increase in the value of their assets. Hence why Channel Islands offshore jurisdictions were, a boon. The industry just moved offshore for a long time. Everyone keeps thinking AFMD would kill the Channel Islands. It did not. They thought the capital gains tax would kill Channel Islands. It did not. Basically, unit trust structures are now still, and will going forward still be, very popular for investment into the UK. I think that's pretty right. I don't know if you want to mention anything. Yeah.
It's our assessment.
I think first people thought, oh my gosh, it's doom and gloom, and the rules have not actually done that. They've been quite permissive of using unit trusts. Effectively, you can either have transparent structures, or you can elect your structures to be transparent, and in that instance, it actually preserves most of the historical benefits. And if you are a pension fund or other type of exempt investor who doesn't pay tax, it really will make little difference to you. Anybody now, if you're offshore, who invests into the UK, who has some sort of increase in the value of the property, will have a capital gains tax charge, but that is no different to anywhere in Europe. So really, it's creating more of a level playing field with the other European jurisdictions. And if you're really interested, come to the seminar.
Good. Does anybody have any other questions or anything that's not been addressed? Take that as a no. So we'll do the next event in this series towards the summer. There'll be a mailer coming out about it. You're welcome to join us for tea and coffee afterwards. And thank you for coming. Thanks for our speakers, Kerry Olsen and Cass, for hosting.